All right, that was EC President Christine Lagarde speaking in Frankfurt as the central bank cuts rates for the 8th time this year. It hasn't been 9 times. If you don't remember that it was 9 times, that's because it wasn't 9 times. This is Open Interest. I'm Matt Miller alongside Katie Greifeld. You know why I say that, right?
Because President Trump truthed it the other day.
And Ferris Bueller.
And I actually did not catch that part of the reference, but the ECB cutting rates as predicted. Shall we talk about the U.S. equity market, which has been open for about 10 minutes here?
Yeah, and
giving up our gains, down about 0.1% when it comes to the S&P 500, even though we got some very interesting news when it comes to the trade negotiation stance between the U.S. and China, Matt.
Yeah, I was also going to say relatively close to a bull market. I didn't notice that we turned back down.
Yeah.
If we rise to 59.79, and of course we had hit that level for a while yesterday, we would be at 20% up from the lowest level. So we could still make it today, but we kind of retreated yesterday. So now on a closing basis, we're up 19.8% from the lows in February.
You did see the NASDAQ 100 manage to close in the green yesterday, which was interesting. The overall index faded, but tech held up. And a lot of the future direction could be determined for the tech index. Tonight, we have Broadcom earnings and a few others. But for right now, it sort of feels like a holding pattern.
Right, it does. Although I think it's interesting to look at rates. We're pretty low right now at 4.35 on the 10-year. The news you're talking about that hasn't moved markets. President Trump and Chinese leader Xi Jinping reportedly actually had a phone call. The U.S. president has been begging the Chinese president to call him for months. And so now I guess it's actually happened. Let's get the latest from Bloomberg Washington correspondent Tyler Kendall at the White House. So who called whom?
Well, Matt, we actually, according to China, they are saying that this was at the request of President Trump, which does track with what has been a long-held position by this White House, that they would like to see these two leaders hop on the phone directly. Now, we are still waiting on formal confirmation from the White House, but this does mark the first formal contact between these two leaders since President Trump took office. And it really is a remarkable development, considering that our reporting has really indicated that China would prefer for key advisors to iron out the issues before putting Xi Jinping on the phone. And those issues really have been mounting in recent weeks, including the U.S. accusing China of slow walking those export licenses when it comes to critical and rare earth minerals. And those accusations of violating the agreement that was reached in Geneva and ultimately led to a thawing that we saw really do go both ways as China raises concerns about new AI chip controls, not to mention plans to revoke Chinese student visas. So tensions really had been escalating here, but those are potentially, if we do get a readout from the White House, some of those themes that we're going to be watching, as of course this comes against the broader backdrop that they are trying to negotiate a trade deal.
Yeah, certainly a lot for those two to talk about. Really appreciate your reporting there. That is Bloomberg's Tyler Kendall. Let's keep this conversation going with Michelle Weaver. She is Morgan Stanley U.S. thematic and equity strategist, joining us at the desk. Great to see you in person, Michelle.
Thank you for having me.
So let's take the temperature here when it comes to trade talks and how the market is reading this, because as Matt said, you initially saw a spike when we got the news that actually President Xi and President Trump had spoken by phone. It quickly faded, though, and a phone conversation is not a deal. There's a lot to work through here, but talk to us about how you're thinking about the posture right now.
I think there's going to be a lot of twists and turns before the tariff matter is fully resolved. But what I think is really important from our perspective is I don't think you're going to see the levels that we saw post-Liberation Day. I think the lows for the year are likely in unless you get a pretty dramatic shock to the market. I think, we're going to continue to trade around tariff headlines. Companies are trying to think about how they can manage tariff risks. Investors are trying to think about that. But in terms of the broad equity market, I think the lows are in for the year, and we're just going to continue trading and chopping around with some of these headlines.
Does this market expect a base tariff rate of 10% globally? Because if that's the case, it pays off and then some the deficits projected by the CBO. Now, they may be lowballing the deficits we get from this tax bill, but the market seems so sanguine, right? Rates have come down. 4.35 on the 10-year is a long way off from the danger zone.
Yeah, absolutely. I mean, I think I think we're for the rates as we're looking for 4.5 as the level where that could become a risk to the equity market. That's where you typically see correlations between yields and equity prices turn negative. We're far off the danger zone there. I think the tax bill is the next thing that the market's been thinking about, but we still have a lot of negotiation to go around that.
Is the stock market thinking about what's going on with the tax bill? It feels like it's being very clearly expressed on and off in the rates market. But when it comes to the stock market, I feel like it's a much less clean sort of correlation there.
Absolutely. I think it's a much less clean story, but there's still so much negotiation to go on there. We don't know what the final version of that is going to look like. But from our perspective, we're looking for policy to become more beneficial for the equity market in the back half of the year. We're looking for potential benefit from the tax bill. We're looking for more benefits from deregulation. Maybe the M&A market starts to pick back up around that. But really, first half of the year, policy sequencing has been negative. Back half of the year, more positive on policy.
We had your colleague Andrew Sliman on yesterday. He's been crushing it in terms of returns, right? Beating his benchmarks. You're thematic and equity strategist.
Yes.
What are the themes that you're looking at? What are the ones you like?
So I'm really excited about the AI adoption story. So far, AI has really been, the value has been accruing to the enablers, the people who are making the picks and shovels, allowing AI to be adopted at companies. But now it's time for companies to actually start putting AI into production. And we're a lot more constructive about in late 2025, early 2026, starting to see that become positive for company margins.
Well, talk to us about how that all filters through the S&P 500, because I hear what you're saying, that maybe we'll start to get some of that positivity from, AI actually being used by these companies, but that's not until the end of the year. But then you also talked about the sequencing of we're possibly going to get more market-friendly measures when it comes to taxes, when it comes to deregulation. You add it all together, what does that mean for the S&P 500's trajectory through the remainder of 2025?
Yeah, so we're overall pretty constructive on the S&P. We recently put out our mid-year forecast for next year at 6,500, so fairly constructive on the index overall. And then I would say the next key thing to look for the equity market is what's happening with earnings revisions breadth. We've seen earnings revisions breadth start to hook up pretty substantially for the market, and we're also seeing that metric driven more by positive revisions rather than a lack of negative revisions. So that is something that we're watching, and it looks like the earnings picture is now starting to clear up for the rest of the year.
Is the U.S. still your preferred place to invest? I mean, you are a U.S. thematic and equity strategist, but do you look at your European or Asian colleagues with a little bit of jealousy?
No, we're still, as a house, we're still calling for U.S. over international. That's partially a function of the better earnings revisions breadth picture in the U.S. versus international. And it's also about the dollar. Our forecast is for 91 on the DXY, which represents around a 17% move from the highs, and that will be really beneficial for multinational companies' earnings in the U.S.
17% move down.
Yeah.
From the highs, yeah. Yeah.
All right, we got to leave it there. Unfortunately, Michelle, really great to speak with you. Hope we can do it again soon. That is Morgan Stanley's Michelle Weaver. Meanwhile, let's get a check on this market, which is taking a bit of a leg lower in the first 18 minutes of the trade. I want to take a look at the breakdown right now. When you look at the single stock level, we started out, again, in the green, but now you can see that the breadth is getting worse and worse. You have over 300 companies in the red right now, just about 174, 75 in the green. What's still leading, and this is good news, is some of your big tech names, Amazon, Alphabet, Microsoft, the list goes on, but very small moves overall. So that downside starting to overwhelm here, because right at the top, Tesla down almost 6%. That's taking 6 points off the big index. Nvidia too, hurting as well. Then you have the likes of Costco and Eli Lilly. Let's take a look at how this is translating into the sector picture as well, because up at the top, you do have communication services, but a small move. Again, energy and materials also fighting to stay green right now. Then you go down the bottom and you absolutely have more red than green today. Financials, consumer discretionary, and consumer staples, Matt, some of the biggest laggards in this market right now.
All right, let's shift gears here for a moment and talk about the jobs market and really Google, because Alphabet CEO Sundar Pichai says his company will continue emphasizing human talent as the AI boom continues. They'll continue hiring humans instead of trying to replace them with artificial intelligence. He spoke last night at the Bloomberg Tech Conference in San Francisco.
I expect we will grow from our current engineering base even into next year. I just view this as making engineers dramatically more productive, getting a lot of the mundane aspects out of what they do, allowing them to spend on higher value-added tasks. People will be able to do more, which means maybe we'll create new products, and hence we will need more people, at least in the near term.
Joining us now is Bloomberg Intelligence Global Head of Tech Research, Mandeep Singh. And Mandeep, it does look like we're going to need a lot more engineers. Even with AI, we won't need as many private equity fund managers, apparently.
According to the Vista CEO.
But what's your outlook for hiring in Silicon Valley?
I mean, look, Microsoft just did a layoff of 6,000 people, 3% of their workforce. So from that standpoint, it's surprising to hear him say that he's looking to hire more engineers. At the same time, everyone is looking for ways to do more in terms of AI agents and just, the field of large language models. It's evolving in terms of how their search product is changing. So look, there are a lot of optimizations that will happen in terms of the engineers and how they'll be used across different products within Google. But at the same time, there is still a lot of demand for people who understand, this field of large language models. And that's what I think he was alluding to.
I also want to talk about, this is a long-term story that we're talking about when it comes to labor, human versus robot labor. Let's talk about what's going to happen after the bell today, and that is Broadcom.
Yeah.
It feels like the stakes are really high for this company. If you take a look at its one-year performance, it's up about 86% on a total return basis. NVIDIA shares up just about 16% in that time. So talk us through what you're expecting when we hear from this company after the bell.
Yeah, look, we saw NVIDIA grew 70% despite the China headwind, and they wrote down, quite almost like 7% of their revenue that they couldn't sell to China. Broadcom has a very high exposure to Google. Almost 50% of their AI revenue comes from Google TPUs. And Broadcom is a much lower run rate, $18 billion business, as opposed to NVIDIA, which is almost close to $200 billion on the AI side. So clearly, there's a lot of runway for Broadcom. And Broadcom last earnings mentioned they added 2 new hyperscalers. Now, those 2 could be OpenAI and probably Meta or someone else. Maybe they are exposed to Project Stargate. We don't know exactly. But clearly, they are gaining more customers who are thinking about moving out of NVIDIA's ecosystem and doing more custom ASICs. So from that standpoint, I think any new customer they add will add, probably 10 billion plus in revenue down the line for Broadcom. And it is somewhat of a zero-sum game to my mind. If you're moving away from NVIDIA, you're probably coming to Broadcom.
All right, there you have it. And hopefully we'll be able to name those big customers soon. That is Mandeep Singh of Bloomberg Intelligence. Now, we also want to talk about Lululemon, the next big retailer to report earnings, with the first quarter results coming after the bell. Bloomberg Intelligence says that sales growth could slow to as little as 6%, weighed down by, you guessed it, tariff concerns and consumer spending. Shares are down more than 12% this year, but higher by about 9% over the past year. So let's break it down now with Bloomberg Intelligence senior U.S. retail analyst Poonam Goyal. So Poonam, we had Gap report in the last couple of weeks. It seems like Athleta didn't fare too well. How does that tee us up for Lululemon after the bell?
I think it's a little bit of a different story here. Lululemon has made progress from where it was with really getting better merchandise and a color wave in stores. So we do think that this quarter will shape out to be in line with their guidance, which is for a 6 to 7% increase. The one thing I'd say that Lululemon is doing well right now is that they're adding a more casual flair to their assortments. And that's interesting because as wardrobes shift and consumers rebalance it, moving away a little from activewear and into more work casual wear, they're going to benefit from that.
Yeah, I have to say, I exclusively wear Lululemon pretty much to work. So
I hope they don't get away, though, from the yoga pants. I just like this, the standard yoga pants.
All right. For yourself, I assume you're talking about.
Of course.
Poonam is moving swiftly along here. Talk to us a little bit about the competitive environment here. I mean, when you put aside tariffs and consumer spending concerns, which is hard to do, I mean, you think about the fact that you do have Athleta, you do have Vuori, you do have Alo. It feels like this space is getting more and more crowded.
I think the space was actually always crowded. In addition to those names, you also have Nike, Adidas, and the traditional activewear companies really making a big push on fashion style to get them also in that, casual athletic flair. What I'd say that Lululemon is doing well is they have the customer base, right? They have a loyal following of people who just love what they have. And as long as they get the assortments and the color palette right, which is where you could say, messed up a little last year, I think they're still on the way to gain share, especially internationally, where they do have a goal to quadruple sales. And I think they're going to be able to do that for 2026.
All right, Poonam, thanks very much. Poonam Goyal from Bloomberg Intelligence talking to us about Lululemon. 40 analysts cover Lulu on the Bloomberg terminal.
Right.
20 buys and 20 not.
Yeah.
So, and they've just been up and down, up and down, up and down, and finishing like unchanged over the last 5 years.
Yeah, it is pretty amazing to see it pretty much flat over the past 5 years, to your point. Extremely high peaks and valleys there. Let's take a quick check on this U.S. market overall, though, because I'm a little bit surprised here to see gains fade. Those pre-market gains that we saw after we got news of that President Trump, President Xi phone call, we're now pretty firmly in the red here.
Well, nothing came of it, and
right, but they got on the phone, which was hard to do.
True. I mean, he got on the phone with Vladimir Putin.
That's true as well.
And there's not any peace in Ukraine right now. Coming up in the next hour, Emily Rowland joins us from John Hancock. She says earnings growth is diminishing. We'll talk to her as well as the man behind Sony and Honda's smart car. This is Bloomberg. All right, 30 minutes into the trading day, markets have turned firmly lower. S&P 500 off 1/3%, still at 59.51. NASDAQ down 0.2. Welcome to Bloomberg Open Interest. I'm Matt Miller.
And I'm Sonali Basak. It's interesting to see. We have a little bit of economic weakness shown in the initial jobless claims. Let's see what tomorrow looks like. You made a great point in the commercial break. Waiting for payrolls. That's the big moment of the week.
Wait, you made that point.
No, you made it first, I think.
No.
One of us made it. Anyways,
I said that's a great point, Sonali.
Oh, you made the point on Musk also. We're going to talk more about that tax bill later, too. But coming up, trade talk. We have President Trump's and China's Xi Jinping speaking by phone today. We're going to give you the readout. It's their first known formal contact since Trump took office.
Markets also closely monitoring the cost of President Trump's multi-trillion-dollar tax bill, as well as the payout of tariffs. $2.8 billion is the CEO's estimation for the tariff revenue, and that would fully cover the CBO's deficit estimate. Listen to what Mike Johnson, the House Speaker, told us earlier here on Bloomberg TV.
Obviously, the bill is still a live instrument that's being worked on in the Senate, so we'll see if they modify those provisions. But I think for now, I think that's good policy for us. And I want to say to foreign investors, you're in good stead to invest in America.
We'll talk more about Section 899. That is what is discouraging perhaps foreign investment. Plus, the payrolls report. We've been talking about it. It looms large. Job cuts are piling up around the world. And billionaire Robert Smith has sounded the alarm about AI's impact on the workforce.
Let's start, though, with President Trump. His phone call with China's President Xi Jinping. We get the latest from Bloomberg's Washington correspondent, Tyler Kendall. So, Tyler, I guess the idea is at least there was a phone call, but did we get anything out of it?
Yeah, hey, Matt. So we are still waiting on that official confirmation and readout from the White House on exactly what was discussed. But this does mark the first formal contact between the two leaders since President Trump took office, and since we've really seen a recent escalation of tensions between Washington and Beijing amid allegations that both sides are ultimately violating the agreement that was reached in Geneva. Now, it is considered to be a pretty big development since our reporting has really indicated that up to this point, China has much preferred to have key advisors iron out those issues instead of putting Xi Jinping on the phone directly. But the White House really had been ramping up the pressure in recent days to try to make this phone call happen amid allegations from the U.S. that China is slow walking export licenses when it comes to critical and rare earth minerals that are essential to supply chains here in the U.S. Now, on the other side of this, China has really been raising these concerns in recent days about new AI chip curbs, also plans to revoke Chinese student visas. We should also mention, Matt and Sonali, there has been also recent tensions rising when it comes to the geopolitical space after Chinese foreign ministry officials this week protested an assertion from Defense Secretary Pete Hegseth that China poses an imminent threat to Taiwan. So there's been a lot brewing up leading up to this conversation.
All right, Tyler, thanks very much. Bloomberg's Tyler Kendall there at the White House. Joining us now is Emily Rowland, co-chief investment strategist at Manulife, John Hancock Investments. And Emily, there are all of these sort of up and down arrow stories. We have the tariffs, obviously, and the trade war. We've got the tax bill, obviously, and the deficits. What matters to you when you're watching these markets?
Yeah, Matt, it's a great question because there's been this myopic focus on developments out of Washington, and it's really been a market, in our view, that's been driven by feelings and not facts. So it's been driven by political uncertainty and just sort of lack of confidence in what's going to happen next in the economy. But when we look underneath the surface, the facts are telling us that earnings growth in the United States has been great. S&P 500 just saw 13% earnings growth in the first quarter. Analysts have revised expectations down a touch to about 9% here in the United States. But meanwhile, we're seeing worse economic data, worse earnings growth overseas. So IFA, for example, saw negative 6% earnings growth this quarter, but momentum is pushing investors out of the United States and into Europe. So we're focused on the facts right now. Better economic growth in the U.S. I'm not saying we're great. We're sort of the cleanest shirt of the dirty laundry from an economic growth perspective, but we would consider trimming into the strength in some of these riskier areas and redeploying capital into the United States.
It's interesting. Matt and I were kind of talking about why the sour mood today. You have the S&P 500 breaking a 3-day winning streak, but I also want to point out, because blinking you might miss it, the Bloomberg Dollar Index actually hit the lowest since July of 2023. That low was last set in late May, pretty recently, but this dollar movement tends to recently be indicative to a lot of executives and investors on that feeling, that sour attitude around the United States and U.S. assets. Can you take anything more from that? I mean, what do you make of this move?
It's a great observation, and we went so quickly from U.S. exceptionalism that really dominated, in the back half of 2024 to this sell everything America phenomenon that we've seen permeate markets in 2025, whether it's stocks, whether it's currencies, you name it, bonds, as bond yields have backed up. And we really look at this as based on sentiment and based on feelings. And we think about the weaker dollar also as something that's been pushing investors into these more cyclical areas. So when the dollar weakens, your returns overseas are flattered significantly. In fact, you look at Europe up 22%. Year to date, and that's about half of that is due to the weaker dollar. So in an odd way, the sell America everything has actually pushed investors further into risk and further into momentum, given that strong performance of more cyclical Europe.
What do you think about valuations, Emily? I always look at the Bloomberg estimate for PE when I see relatively high levels on the S&P 500. We're over 5,900, getting closer to 6,000, and looking at 23 times forward earnings. Is that seem fair to you?
Yeah, it's not a great starting point, Matt, and we're about 5% from all-time highs in terms of the forward PE ratio on the S&P 500. So there's a little bit more room here, but we just don't think we're going to get much more multiple expansion, especially after two really strong years in 2023 and 2024, where that 50% return on the S&P 500 over the course of those 2 years was almost completely coming from multiple expansion. So we think the denominator denominator and the PE ratio here is going to be a lot more important. We want to look for companies that have great earnings growth prospects. We are finding them in the United States. Again, analysts penciling in about 8-9% earnings growth. We also want to be really careful of how much you're paying for that earnings growth. So we look really closely at something called the PEG ratio, which is an indication, again, of how much investors are paying for future earnings growth. And we're finding more compelling numbers. It's kind of like golf, the lower the better on the PEG ratio, in sectors like healthcare, communication services, technology companies. That's really where we're gravitating for those pockets of opportunity within a U.S. market that's pretty expensive today.
Emily, we thank you so very much for going cross-asset with us. That is Emily Rowland of Manulife, John Hancock Investments. Of course, it's all so related. There's so many things going on. But I do want to hit on some breaking news. This one is remarkable to me because Circle is indicated to open at $42 to $44 a share. The IPO priced at $31.
Massive.
Amazing pop that it could have. Now, stable coins, of course, we're looking at the Senate, looking to pass another stablecoin bill here. So that's, of course, a huge boost to Circle. But they already had inked about a $7 billion valuation in their IPO last night. They could be worth a lot more today.
And you anchor the crypto show, so you've been watching this very closely. Plus, you watch IPOs so closely. There's a great window right now to go public, and they're definitely taking advantage of that. Coming up, the EV race is about to get a new entrant from a pair of heavy hitters. We're going to speak with Jun Koketsu from Sony Honda Mobility, where he is the general manager. This is Open Interest. Let's get to high interest now. Look at what's making headlines around the world. President Trump signed a proclamation that bans people from 12 countries entering the U.S. The ban covers countries including Afghanistan, Chad, Haiti, and Somalia. The measure also partially limits entry of people from Cuba and Sierra Leone, among others. The ban will not apply to those who already have visas, lawful permanent residents of the U.S., or teams traveling for the World Cup or the Olympics. Elon Musk's AI startup, xAI, is set to get debt backing from TPG. The deal is one of several fundraising efforts across Musk's companies, which come as the billionaire pivots away from politics, or at least his official advisory role in the White House, and refocuses on his businesses. Musk recently merged xAI with his social networking platform X, formerly known as Twitter, into the company called xAI Holdings, and he's been investing heavily in its Memphis data center called Colossus, which the debt sale could help to finance. And Chinese officials have summoned the heads of major electric vehicle makers to Beijing earlier this week to address concerns about the long-running price war. The officials told EV makers that they shouldn't sell cars below cost or offer unreasonable price cuts. The move comes amid mounting concerns the price war could send some of the weaker companies there into bankruptcy. However, the gathering didn't result in a mandatory directive. Speaking of EVs, Honda and Sony are teaming up to enter the EV race together. The Afeela 1 is expected to start deliveries next year. The all-electric sedan is estimated to have a 300-mile range and starts at $90,000. Sony Honda Mobility began taking pre-orders for the car back in January. And joining us now is Jun Koketsu, Sony Honda Mobility General Manager here on set. Jun, great to have you here in the studio. Thanks so much for joining us.
Thank you.
Tell us about this car because, I think it's fascinating to see these sedans like the Lucid that are so high-tech and advanced, but also expensive and not necessarily what the consumer wants. Why not start with an SUV?
So I think why we started with the sedan is, of course, this is our flagship models. So I think we want to start off with the premium sedan with the top-notch technologies here. And we have 40 sensors inside and outside the vehicle, together with the 800 TOPS of processing power. So our aim is that more entertainment, less driving. So we have a foundation of our ADAS technology, which covers level 2+, and having reducing the burden of driving people will be able to enjoy more entertainment content on the go. So.
How soon will it be available outside of California? You could tell outside of LA, you're going to be stuck in traffic. You might want that entertainment value. You might want that entertainment value driving home from New York City to New York State as well. Are you thinking about new markets already?
It's in our roadmap, but first and foremost, we'd like to start off with California, and especially in terms of like what happens after customer buys the product. There's always a maintenance and repair. Those operations needs to be settled, and then after that, we're trying to think about scaling to other regions.
You are going to build it in the great state of Ohio. My hometown, right outside of Columbus. Thanks you for that. Why do you pick, though, other than the fact that it's an amazing place to live, why do you pick Ohio?
So we are a joint venture of Sony and Honda, 50-50, and actually we are manufacturing, utilizing part of the Honda's manufacturing facilities, and that happens to be in Ohio.
I'm glad you talked about the joint venture because I think there's a lot of question about the sustainability of a joint venture. When it's 50-50 in that manner, how long can it last for? How do you assure people that the joint venture will last?
I think, we have a long vision in mind, and then that, Sony and Honda has a similar culture in terms of really, making a new movement happen. So our focus is the future of mobility. And, I don't know for sure how long, but, we just started. So I think we will be trying to challenge as we move forward.
How's your grasp on the supply chain? Because we've been reporting about difficulties that even the giant incumbents here in America have had getting a hold of critical minerals, getting a hold of the magnets that you need, especially for such a high-tech vehicle. Are you able to get all of the stuff that you need to build it?
So we are getting support from our mother companies, including those supply chains. And due to the fact that we are manufacturing in US, and then also some of the key components like batteries are also to be planned to be purchased within the US area. So we think that there are impact, but we would like to make it minimal as possible.
How closely are you watching U.S. policy? We reported this morning that Elon Musk has been having direct conversations with lawmakers about the EV tax credit that has helped the company so much in recent years. How important is that type of policy to you at this point? And are you making more significant lobbying efforts as well?
So we do have lobbying activities going in place, but basically we are carefully watching what is happening around the U.S. and making sure we are compliant with all the laws and regulations.
What about the name, Afeela? What does that mean? Are you going to stick with it? Where does it come from?
That's a popular question. So if you look at the name Afeela, there's a feel in the middle of our brand name. So that is coupled together with autonomy and augmentation. Autonomy being the fact that we want to reduce the burden of driving experience. And then autonomy meaning that there's more entertainment content that could be enjoyed in cabin. So together with that, it means Afeela. So.
Jun, we thank you so much for talking to us more about this car. Looking forward to seeing where it goes. That is Jun Koketsu of Sony Honda Mobility. Now, still ahead, the Vista CEO tells a crowd at Super Return that 60% of them will be looking for a new job in a year. We're going to tell you why he's sounding the alarm. This is Bloomberg Open Interest.
It's a very futuristic point of view, but I think it'll make white-collar jobs more productive and people a lot smarter. Think about how we use it personally. I use ChatGPT and all kind of models all the time. I say, hey, write me a paper on this topic, but then I can think a lot more thoughtfully and more deeply about that topic and improve it and spend my time, once again, much better than rudimentary first drafts.
Thoma Bravo co-founder Orlando Bravo speaking with Bloomberg's Danny Berger from the Super Return Conference in Berlin. And that brings us to today's Wall Street beat because there were fireworks. Vista CEO Robert Smith also in Berlin warning that, quote, next year, 40% of the people at this conference will have an AI agent, and the remaining 60% will be looking for work. Joining us now, Bloomberg Intelligence senior banking analyst Tomasz Nitzel. In a recent report, Tomasz indicated that the Wall Street job losses could top 200,000. Large numbers. Of course, it's a big industry. I actually thought what Robert Smith had to say, it was amazing to look at a crowd and say, well, more than half of you won't be here. You'll be out of a job next year. Do you think that he has a point there?
Yeah, that's definitely a big number. 60% is a massive number. I think it is a similar number that IMF projected 2 years ago about AI. However, about the banking sector, the story looks a little different. What we have done, we ran the survey for more than 90 global banks to understand what is the impact of AI on productivity, on cost, on workforce. And our findings suggest that only around 3% of jobs will be at risk in the next 3 to 5 years from AI deployment. And that is equivalent to around 200,000 of jobs for more than 90 banks that Bloomberg Intelligence is covering. So this 3%, 200,000 numbers, 200,000 is a big number, but if you look at the whole industry, 3% is not that much. 40, 60%, these are scary numbers, and yeah. I think it is. You have to look at different industries really differently, and definitely in the banking sector is a little bit different story.
Well, my immediate thought went to, assistance. Tomasz, because he was saying AI assistants will be helping 40% of them, and that gets rid of, 60%. How much of the support staff at banks is gonna have their work kind of replaced by AI assistants? It seems like 200,000 in that case is a low estimate.
Low. It can be low estimate, but look, Matt, I think it's very important to understand what are those AI agents, right? Because 2 years ago, everybody was hype about Gen AI, and I think 2025, 2026, and go on will be AI agents. So where AI agents are your assistant that help you with your daily jobs. Actually, I was in Amsterdam this week on Money 2020 conference, and AI agents was a very big topic over there because this is definitely transformative for the banking sector. However, to fully deploy AI agents is not that straightforward. You need to have an infrastructure. You need to have good data you can work on. You need to have flexible system that will allow you to scale the opportunities of AI agents. So it's very difficult to implement. It's not that easy. And look, lots of banks are still working on a very legacy system that are not able to use AI or Gen AI fully. So there's lots of work to be done to fully deploy AI agents. So in the next 3 to 5 years, I would expect massive investment from the banking sector into that to deploy this fully. And maybe in the longer term period, there will be further job cuts because those AI agents will free up resources, will free up time for analysts, for front desk people. So it's not that straightforward. And you have to, as well, for the banking sector, you have to look at regulatory concerns, compliance concerns, KYC, AML. There are lots of risks using agent AI. Agentic AI is called at the moment. So you have to look at the risk and you have to look at the reward. So definitely deployment of those in the banking sector will accelerate, but it will take time. It's a step-by-step approach.
Tomasz, we really appreciate your analysis. That is Tomasz Nitzel of Bloomberg Intelligence. Amazing report that he had out there. And be sure also, we had a hard time finding which story we wanted to focus on today because there's so many out there. Yeah. There's a really awesome story out on Business Week. The latest profile on Bill Ackman takes a deeper dive into his latest ambition, becoming the next Warren Buffett.
Yeah, I don't know if he's going to love the illustration, but it is a pretty fascinating story. Highly recommend giving it a read on Bloomberg.com. This is Bloomberg.
And it's been a mixed bag for big pharma stocks this year, and this comes as the Trump administration is targeting healthcare costs in the United States. Trump signed an executive order last month pegging U.S. drug prices to those paid overseas. Joining us now live from Boston, Dan Mendelson, CEO of Morgan Health. Morgan Health is a division of J.P. Morgan Chase focused on improving employer-sponsored healthcare in the U.S. And I, before this, looked up, Dan, how much it's really costing now in terms of of premiums for a family. And it has gone up over the last couple of years. It's been pretty stunning. In fact, if you really look, it's more than a third, at least a third of median household income in the United States. Where do you even begin to fix that? And does the administration's plan start to?
Look, the healthcare cost increases are unsustainable right now, and they're right to be focused on it. Medicare, Medicaid, and also in the commercial market. This year, for large companies, costs are likely to go up by about 10%. For smaller companies, it's even worse. It's more variable, and some of them will be seeing cost increases in the 15 to 20% range, and they just can't sustain that.
In terms of the deals that we've seen so far this year, do you expect that to continue? Because it's been pretty hot.
Yeah, it will. And look, a lot of it is being driven by technology. And these are the solutions. We have to be deploying more AI. We have to be deploying more technology. We have to bring that in. Consumers have to be able to see the cost of what they're buying more easily. And then I think, a lot of what we're doing at Morgan Health relates back to fixing the delivery system, making sure that that employees can really see and understand, what it is that they're buying.
A lot of people, Dan, want to blame the pharmacy benefit managers. A lot of the drug companies want to do that. A lot of lawmakers want to do that. Certainly, Mark Cuban would like to do that as well. Are they the problem, or does it go far beyond that?
Look, I think it does go far beyond that. We need these pharmacy benefit managers to establish a competitive marketplace for drugs. We need them to be delivering the pharmaceutical products. I mean, they serve a function. And the fact is that, some of their pricing is objectionable in the sense that these rebates that are charged often do not accrue back to the people who are actually using the drugs, and that's a problem. I think it's something that the Congress is focused on and likely to fix. But the problem does go far beyond just the efforts of the pharmacy benefit management companies.
I mean, Dan, when I go to the pharmacy, sometimes I'm getting $100, $200, $300 bills here. When I was living in Berlin and getting the same drugs at the pharmacy, it was like €7.39. Is that down to the middleman, as we've been hearing so much, or do those countries, meaning like every single country in the world outside of the United States of America, just do a much better job negotiating with the drug makers?
Well, they're not really negotiating; they're just setting the prices. So there are price controls in virtually all European countries, and that does depress the cost of the drugs. Look, these healthcare systems are really making sure that people don't feel the costs of the products. In our country, it's different, and pharmaceutical companies are allowed to charge what they want. It's a competitive marketplace. So that's, I think, something that will continue to be a facet of our system.
We're still looking at Congress hash out the tax bill. But when you look at the Medicaid cuts that are being discussed, what is your general thought on where this leads at the end of the day and what it would leave people without?
Look, I think that first, we have to get the cost of the entitlement programs under control. It's a fiscal issue. It is important, and it's sad to me that it isn't more of a bipartisan issue, because getting the cost under control is really a major imperative to get our country back on track. With respect to the way that they're doing it, you want to see reductions in costs that don't result in a lot of people losing coverage. And I think that the Congressional Budget Office estimates that there would be millions of people who will be losing their insurance are definitely a big concern. So it's really more a matter of how it's being done as opposed to whether it's being done.
Dan, you're in a great position, I think, to judge how well we're doing in terms of medicine in general at solving diseases, right? A lot of the deals that we've seen recently have been in immuno-oncology. Are you optimistic that we're making real headway against things like cancer, against things like Alzheimer's disease?
Look, absolutely. And I would say that the innovation pipeline has never been stronger. The GLP-1s as a class have been transformative. You have cell and gene therapy that are coming through. It's a lot of very fundamental science is coming to fruition over the coming years. And, my optimism comes from not only that, but also the advances in AI and starting to bring intelligence into the way that we're structuring healthcare delivery.
Dan, for those who don't remember, the precursor to Morgan Health was this massive initiative put forward by JP Morgan, by Warren Buffett, this bid to really change the face of healthcare between the relationship between employers and their employees across America, right? So when you came in here, 2021, Morgan Health was really conceived. It's the second rendition of this. Since 2021, what can you say would be your biggest success? What has been accomplished for you in this grand plan that JP Morgan has had?
So our focus is driving innovation in employer-sponsored healthcare. About half of Americans get their insurance through their employers. We've made 10 investments that are very fundamental. We're working with a lot of great innovative companies, and what we're doing is expediting change. And so a lot of what we're focused on is getting better primary care and better prevention to America's workers. We're focused on bringing digital technology in and leveraging the power of AI. And it's really in the acceleration of the companies that we're working with that we're most excited. And look, I think that we go into it with a lot of humility. We don't believe that we will be able to solve all the problems immediately, but by raising up these issues and by accelerating the progress of innovative companies, we've been able to make a real difference.
Dan, great to have you on the program. Hope we can get you back because it's such a fascinating topic and really fascinating innovation, what you're doing there at Morgan Health. Dan Mendelson talking to us about his business. Let's get a check right now on what's going on in stocks and take a look at what I think is really the most dynamic way to view the S&P index on the Bloomberg terminal. This is the move screen, of course. You can see that we started pretty strong, came then down. Right now, we're looking at 159 stocks on the rise, 342 falling. So we do have that kind of negative breadth. The big winners, I should say, in terms of adding points are, as you would expect, Amazon, Microsoft, Google, Netflix, Facebook. And then if you look at the big losers, I think this is where it gets really interesting. Tesla down another 4.8% today. Now, Tesla fell, I think, about 3.5% yesterday. And, you know, Sonali, I think it's interesting that as Elon Musk starts what looks like a campaign against President Trump's one big, beautiful bill, investors are selling off his shares. So as he sort of turns and pivots away from the administration, it does look like it's not helping in terms of the market cap of his company.
Yeah, the great gamble is whether those EV tax credits were worth the pain in between. But speaking of markets, there's been something I've been working on for a long time. I'm excited to share it with you. My new Bloomberg original show, Bullish, is an immersive journey through the high-stakes world of finance as seen by its titans and its rising stars. It's out on June 17th. Here's what it's going to look like.
As Bloomberg's global financial correspondent, I get to meet the people shaping the way money flows around the world. And I want to bring you with me.
Now we're playing. Yep, now we're playing. First and foremost, I am a capitalist. The capitalist system is the best system in the world. There isn't another one that works as well.
Citigroup moves $4 trillion a day.
5.
Wall Street used to be a place.
I love all these new Wall Streets. Y'all Street, Wall Street South.
Now it's more of an idea.
The optimism here is infectious.
You think our New Yorkers are negative?
Yes.
Anything that trains people to understand probabilities and just think through things with a greater degree of nuance is a service to humanity.
I hope you survived the day.
I did. It was a busy day.
And you can watch Bullish Tuesdays live at 6 p.m. Eastern on Bloomberg TV and 8 p.m. Eastern on Bloomberg Original starting June 17th.
I will absolutely do. What a cool sizzle reel. I mean,
Thank you.
You're playing golf, you're playing poker, you're talking with Ken Griffin, somebody's riding a Harley Davidson Fat Boy. Like,
will you teach me how to ride a Harley for season 2?
Absolutely.
That's the only reason I'll do it with you.
Very, very cool. So wait, when is it again? What time do I tune in?
6 p.m. Bloomberg Television, starting June 17th for 6 weeks. It's 6 episodes. fun for me, you're going to get extended cuts of our biggest interviews. So you can listen to almost an hour of Ken Griffin and Boaz Weinstein. And
I guess, can I then see them on Bloomberg.com as well? Can I stream them on YouTube? Like, how else will I access them if I'm not watching on BTV?
You want to hear my favorite part?
Yeah.
Prime Video is where else you could find it. And also, yes, Bloomberg.com, particularly those extended cuts, will be exclusive to Bloomberg.com.
All right, very cool stuff. Very much looking forward to bullish. I want to give you some breaking news right now, unrelated. President Xi telling President Trump that he should remove his negative measures on China. President Xi says that Trump is welcome to visit China again. So we're essentially starting to get a readout of this phone call. President Xi and President Trump speaking on the telephone reportedly, and this is what we're hearing that they spoke about.
Yeah, of course, this is according to CCTV Xinhua. We are watching investors suss this out. Remember, China is 30% of global manufacturing. The U.S. is less than that. We are watching to see where the power really is.
It's also important to mention that we could get a different readout from the White House.
That's
because
true.
Remember, yesterday the White House, or President Trump, tweeted that Putin, for example, was going to launch a serious counterattack on Ukraine for those drone strikes. That was not in the Kremlin readout. So this is the Chinese side of things, and we'll get the U.S. side later.
And it's important to keep an eye on that because it could mean volatility for the rest of today into tomorrow, even before those payrolls. Now, coming up, Elon Musk remains, quote, dug in on his desire to kill Trump's tax bill. Part of our interview with House Speaker Mike Johnson next. This is Bloomberg Open Interest.
Elon's a good friend. We texted late last night. We're going to talk this morning. He seems pretty dug in right now, and I can't quite understand the motivation behind it. But I would tell you that what we're delivering in this bill is not only historic tax cuts, but historic savings as well. He seems to miss that.
House Speaker Mike Johnson speaking earlier on surveillance. Joining us now from Capitol Hill is Bloomberg congressional reporter Eric Wasson. And Eric, you know, one of the things it's kind of hard to get for me to get my hands around is how much this legislation will add to the deficit. Because on the one hand, I see that the CBO says about $2.5 trillion, but that means they're counting on taxes on tips and taxes on overtime, those kind of things, to expire in 2028. And we know from the imposition of a SALT cap that once the government gets its hand around tax legislation, it's really hard to let go of it. So what do you think?
You know, I definitely think that it's probably likely it will add more to the deficit. You know, there's expiring tax cuts, as you mentioned, on tax tips, an expanded standard deduction for seniors, an expanded child tax credit, $2,500 per child. You know, Congress will be very tempted, especially if Republicans remain in power after the presidential election, to extend those. Republicans up here are pointing to a separate CBO score on trade, which said if you kept all of Trump's tariffs that were in effect in May in effect for 10 years, that would raise $2.8 trillion in revenue. But, you know, the administration itself says this is a negotiating tool that could go away as soon as China and others drop their tariff and non-tariff barriers. So it's kind of an unrealistic assumption, but Republicans are pointing to that. They're also pointing to their own growth estimates, as the speaker in his exclusive interview with us said this morning, that he believes this will be jet fuel for the economy and tax cuts will pay for themselves. But that has proven time and again not to be the case.
Eric, ultimately, when this bill goes through the Senate, what is most likely to change? I'm sure that Speaker Johnson would like to keep his dental floss holding across that Grand Canyon, as he told our surveillance anchors today, but there is a fair bit under discussion still.
The biggest change that Leader Thune, John Thune of South Dakota, and his lieutenants want to see is to extend the temporary business tax cuts. There's a host of them: interest expensing, bonus depreciation, basically to reward companies for making investments, especially in factories in the U.S. They'll expire after 2029. So they think this is bad economic policy. In fact, most economists would agree that if you don't want to have business tax incentives, they should be permanent, there shouldn't be a cliff. So they want to extend those, but that could cost hundreds of billions of dollars, and that then causes the deficit hawks to ask for more spending cuts. One of the things that we're talking to members today about, I just talked to Roger Marshall of Kansas, who was saying they might go after Medicare Advantage. Medicare Advantage has become kind of notorious for upcoding procedures in order to get a bigger reimbursement from the government. They may try to curtail that practice and get $300 billion in savings. There are other places they could look as well, but that once again opens up a whole can of worms. There's certainly a lot of nervousness among some people in the White House about touching Medicare and Social Security, the third rails of politics.
Eric, I want to ask, how much power does Elon Musk have with his base, with the Trump base? Because clearly he was a huge help in getting President Trump elected, certainly giving almost $300 million to Republicans, $250 to the president. Are they going to listen to him when he asks his constituents or his followers on Twitter to kill the bill?
You know, we asked members that, and I thought some of the response was striking. Kevin Kramer of North Dakota saying, you know, if Musk was telling me how to get to the moon, I'd listen, but I'm a policymaker. I don't have to listen to this guy. He doesn't get a vote. We saw the Freedom Caucus, who've been the ones banging the drum about the cost of this bill, saying today, Andy Biggs of Arizona, one of the members, where was Musk when this bill was before the House? We could have used his firepower at that time. We were basically cajoled into voting for the Trump agenda, and now he's threatening to have us removed from office. You're a little too late, sir. So I think they're trying to not really antagonize Elon Musk and provoke him to give in a primary. On the other hand, they're saying, you know, your timing is off. Like, where were you when we were discussing this in the House 2 weeks ago?
All right, Eric, thanks so much for joining us. Eric Wasson there on Capitol Hill covers all the news out of Washington for us from our Bloomberg Bureau there. I want to quickly give you some breaking news on President Trump. He has tweeted or truthed about his call with President Xi, saying that it was a very good call. Those are his words. Also adding that President Xi graciously invited Melania and President Trump to visit China. And we know that the Chinese have said Trump is welcome there anytime as well. He did say that the call focused almost entirely on trade. It lasted about 1.5 hours, and that he wants no more questions on rare earth products with China. So we'll see if that holds, and we'll see if it moves the market. This is Bloomberg.
And ahead of tomorrow's job print, we're going to give you a roundup of the latest headlines in the global labor market. Matt, we're looking at job cuts piling up around the world. Procter & Gamble is cutting as many as 7,000 office jobs over the next 2 years as the company seeks to improve productivity.
Yeah, that's globally. Big number, obviously, 15% of the workforce, but around the world. Also, Citi eliminating about 3,500 tech positions. Those are only in China, but that is part of its, I guess, effort to simplify things globally, cutting 3,500 tech positions in China.
Yeah, a lot of this is company specific, but some of this is tied to AI too. A dire warning from Vista billionaire Robert Smith. He predicts 60% of workers in the private market industry will lose their job to AI.
Meanwhile, at Alphabet, Sundar Pichai will keep hiring human engineers. The company says emphasizing talent remains key despite its investments in AI. And we talked to Mandeep Singh about this earlier. He said he thought it was surprising because Microsoft has fired 6,000 people recently.
Yeah, very different strategies here. Where are the jobs, where the money is? We're going to turn now to tomorrow's jobs report. Joining us now, Michael McKee, Bloomberg International Economics and Policy Correspondent. We got a fair bit of data already. What does it all say about the data that's coming out tomorrow?
It doesn't say much about the data that's coming out tomorrow, other than in the sense that we are seeing a slowdown in the data, not necessarily a dead stop. Jobless claims got everyone's attention this morning because they went up to 247,000. That's the highest since last October, an 8-month drop. But there are reasons to think that's not exactly what's going on in the economy. Trade balance halved. That means stronger growth for this quarter because it was the opposite of what happened in the first quarter. But take a look at the jobless claims chart. And what we saw was jobless claims rise significantly on a seasonally adjusted basis, but not on a non-seasonally adjusted basis, which suggests there's something going on out there that tells us there are reasons why we're getting a jobless claims rise that may not match what's actually happening. And it could be because schools are starting to end, and some school districts allow people to file for jobless claims, and they don't necessarily match up with what's going on. So we haven't gotten numbers that tell us.
Wait a second. If you're a teacher and
Not necessarily
it's summer
teachers,
break,
but the bus drivers, the cafeteria workers, people like that can file. And so
they get jobless benefits in June, July, and August, and they go back to work.
And this changes year to year when schools get out. So sometimes you don't see the numbers going up, but the seasonal adjustment factors expect it to. And so we're seeing some odd numbers there. But the payroll report tomorrow, which is what everybody's worried about, first of all, the jobless claims numbers were from last week, not from the reference week, so it's not going to tell us anything about what we're going to get. But we did get some bad numbers from ADP and from the various ISMs, and it does suggest a slowdown. Now, this number that we have on the screen, I think, is wrong at the moment because it's gone down to 125 as people adjust after the latest data. Yeah, but
the whisper number is even lower. Whisper number is
yeah,
112.
We're seeing people get pessimistic about what's going on, but the number that really matters on that chart is 4.2%, the unemployment rate, not expected to change. That's what the Fed's looking at. And so even if we get a relatively weak number, if we don't get a surprise like we did with ADP, then the market may not move that much.
We're going to round down to the third decimal point.
Yeah. All right. Mike McKee, thanks very much for that. In terms of markets, we do have equity indexes falling. We'll see if, they're rising again now.
Higher after the Trump-China news. We'll keep an eye on that. This is Bloomberg Interest. This is a show.